Of course, we had very disruptive geopolitics, needless to say. COVID, Ukraine, now the Middle East with the supply chains, the energy crisis. And there's a reason why we are hitting 16-year highs in interest rates. There's a reason. And interesting is also to see that the US Treasury market is in for a third consecutive year of negative total returns, which has never happened since the Second World War. So I think geopolitics creates a lot of news, noise, and the moment, but then we have to look at the underlying economic development. But there is clearly upward pressure in yields, and from yields, everything else trickles down.
Are we looking at the wrong side of the balance sheet? And I keep asking this question, and I'm not sure what the answers I'm getting is, i.e. we keep looking at interest rates going higher because of the underlying data, but should we be looking at interest rates going higher because they're just issuing more paper, and the chances of issuing less paper going forward is absolutely limited while we're still looking at whopping huge deficits on a global basis?
That's true. I don't think it's yet a structural problem, especially not for the US.
Have you not read the Congressional Budget Office predictions for US debt issuance up to 2030? You hide under the desk when you look at this stuff.
But the US is issuing its own currency, has the global reserve currency, and has a
All right,
much
okay,
larger
sorry, I'll just bring in that other rabbit hole went down. What about if Japanese wage growth picks up to 5% and stays at 5% as well? And the only reason I mention that is because one of the Japanese trade unions, one of the largest trade unions, and I'll just chuck this in as well, is looking for 5% next year. That's the Rengo Labour Organisation, which wants a total pay hike of more than 5%. If they do that, and the Japanese have to react with higher interest rates because of higher inflation, that means, of course, as you know better than anyone, that the JGBs are going to look more attractive, which means the reserve currency is going to look less attractive, and people are going to start parking a bit more money closer to home.
Well, these might be flows, and that's certainly a case, but the sheer weight of the US is the US, and the US economy has been very resilient. It is. 2/3 is consumption and services. It's pretty isolated from the global economic context, unlike Europe, for example, which is much more sensitive to these flows. So I'm pretty positive in that sense for the US. But, you know, if you have wars right now, they are inflationary typically because we have Europe and the US particularly running at full capacity. Interest rate pressure, then you have wars on top of it. So, you know, something might then break at some stage because we have so much higher rates, but so far not. This is why everything has been resilient, even the stock market this year.
With that resilience at play then, are these higher bond yields doing all the work for the Fed right now, and they don't necessarily have to go a little bit more? Or have they perhaps lost a little bit more control at this stage? Like we said, the other side of that balance sheet is them still continuing to issue out that paper, even if it is in their own currency.
The higher rates are doing a lot of the work for the central banks and for the Fed, that's for sure. That's positive. But we have to put these higher rates into a context over 2 and 3 decades. We have basically a normalization of the monetary environment, and the aberration was the post-2008 great financial crisis environment. So we have to get used to higher for longer interest rates. The question is how we digest, and anybody who has to refinance, be corporates, be countries, be households, you know, is under big pressure the next 12 months. And I would not be surprised to see a financial accident here and there. Yeah. And then, of course, the central banks would blink in order to secure financial system stability and functioning capital markets.
So what does a blink look like to you then currently in this market?
A blink is always, I mean, a major banking crisis, anything which could destabilize short term. We have seen it with the bank failures.
So an SVB type situation all over again?
Yes. But that's not the overall system, but it's part of the system. And then, of course, it's firefighting and the